With some thoughts on the markets and where you might be putting your money these days, Oakmar's Tony Coniaris joins us this morning. Tony, welcome back. Always good to have you.
Thanks for having me.
I wonder, just before we get to some of the names that you're watching, whether or not this environment we've been in for about a month, where people are talking increasingly about a year-end melt-up, is making your stock selection more challenging.
Well, the last month we've seen a continuation of a trend we've been seeing for several years, and that is that it's a market of haves and have-nots. There's a sentiment today that's something like, you know, if you're not a unicorn, you're a dinosaur, and therefore uninvestable. And we're seeing that in the payment space. We've seen it in autos. And at Oakmar, where we're focused on intrinsic values, we've been taking advantage of that.
All right. Yeah, I think the term we used yesterday on one of our shows was dino tech, as opposed to unicorns. Speaking of the payment space, Fiserv apparently has your interest.
It does. About 40% of their business is in the payments area, where all the controversy is there's lots of new entrants. And before I get to that, just top down, this is a $102 stock that is going to make roughly $6.50 in earnings next year. That's a 30% discount to the overall market. It's growing at multiples of the average S&P company with a much higher return profile. Bottoms up, you look at the payments business here, and there's unicorns in the dinosaur. That's how I would describe it. So they have a business called Clover. Clover is a small business merchant acquiring technology. It has roughly $200 billion in gross volume running through the network. It's larger than Square today. It's growing in the 35–40% range and has a lot of value. And that'll help ensure their relevance going forward. And then there's a business called Carrot. Oh, yeah.
Sorry. Yeah, I just want to, I'm curious because I assumed you hold it into the last earnings print where it got beaten up. I mean, there is this sense in the payment space in particular that things are slowing or that new competition is coming in some way that is going to severely crimp their ability to grow. You obviously don't believe that. I didn't mean to cut you off there, but I did want to follow up and ask why do you believe that?
Yeah, no problem. And that's why I focused on Carrot and Clover, because these are the types of investments you want your management teams to make. At Oakmar, we look for good management teams that are thinking about the future. And this management team has been thinking about the future, and they've made investments to stay relevant as things shift, like in small merchant acquiring, and they've made that transition with Clover. And then you look at something like Carrot, which is where e-commerce is. There's a lot of new entrants there. Think of like an Adyen as an example. Adyen has a market cap that's $80 billion. Fiserv's is $67 billion. Adyen trades at 80 times revenues. Could be cheap, could be expensive, but a lot has to go right. At Fiserv, they have roughly a similar amount of revenues, and the market cap is $67 billion, and they have 10+ billion of revenues elsewhere that's very profitable. So it's just a situation where there are unicorns trapped in a dinosaur, and the market isn't giving full credit.
So when we talk about intrinsic value, I mean, you just talked about the unicorns trapped in the dinosaur at Fiserv. Where else do you see those other type of examples? And I guess just as importantly, at a time where perhaps other companies with unicorns trapped inside of dinosaurs are starting to spin out some of those businesses, is that a possibility to realize greater value for some of your investments?
I think it's a possibility. It could be the reason ValueX involved at Fiserv. I don't know. And another company like this would be General Motors, right? They have this cruise business, which has been, verified by third parties. They've invested in the business and valued it at roughly $30 billion. And the stub of GM that's left is trading at a low single-digit multiple of pre-tax on the auto business. You look at the market value of the old big three in Detroit versus the big three EVs, and it's astonishing. The big three EVs are, what, 1.3 trillion in market cap together, and the big three formerly U.S. automakers are something in the 200 and change range, all in together. I mean, one could be cheap, one could be expensive, but a lot has to go right for the 1.3 trillion to be right.
All right, but you're more of a value guy, but this may be 1998. I don't know. It could be 2 more years, Tony, of watching this, of head-scratching multiples to to revenues that are many years out. I assume you just stick with it because this is what's worked for you in the past?
Exactly right. It's what's worked in the past, and worrying and hand-wringing about when it's going to start working is just unproductive. And at Oakmar, we're more focused on the businesses and the management teams behind them.
Shepard Smith here. Thanks for watching CNBC on YouTube.